Hello and welcome to The Money Show, your daily guide to the world of personal finance only on ET Now. Your daily guide to the world of mutual fund only on ET Now. So, if you also have any queries related to personal finance, mutual fund, or you want India's top experts to review your portfolio, then our number is flashing on the screen, QR code is flashing on the screen. You just message your question to us. You can write to us also on our email ID, also themoneyshow@etnow.in. You can send your queries after the break. We'll take all your queries related to the personal finance mutual fund. So moving on, on today's show, we are starting with the latest development in stock market, which is closing auction session, or CAS, is changing how the market arrives at its closing price, with potential implications for passive funds and index tracking. The system is designed to concentrate liquidity at the close and allow trades to be executed at a single discovered clearing price rather than relying on execution across the final 30 minutes. So, could CAS, the closing auction session, help reduce tracking errors, make large index rebalances more efficient, and limit end of day price distortions? And what could this mean for passive funds and institutional investors as India moves closer to global market practices? To discuss this, I am joined by very special guest today, Sunil Subramaniam, market expert, to discuss on the closing auction session and impact on market participants, index fund, and other retail investor. Thank you so much, Sunil sir, for joining the Money Show.
Good evening. Thank you.
Sir, to begin with, just for a better understanding of for our viewers, help us understand this closing auction session in a very simple way, so our viewers can also understand how this will impact their NAV, how this will closing auction session will impact their mutual fund returns or index funds returns also.
Yeah, sure. So first, let's understand the old system for a minute. The old system was called VWAP, which is volume weighted average price. So what they used to do was, over the last 30 minutes of trading, all the buys and sells would be put in, and based on the volume of the seller, the price would be different. Let us say I sold 10,000 shares of HDFC Bank at an X price. Somebody else sold 1,000 shares or bought 1,000 shares of HDFC Bank at a Y price. So I would get a 10:1 weightage compared to him. So the big players dominated this last half an hour, and they would wait for that period to go because they would like to make sure that they get their price. So there used to be a lot of things that the block deal or the big deals done in the last half an hour would actually change the whole dynamic of the day for that particular stock, especially in the F&O side. So I think this was causing a distortion. And second is that the world has already moved into a closing auction session worldwide. India was lagging behind. So I think SEBI got the feedback from international fund managers saying that when it comes to India, we are faced with this challenge because an active fund manager would try to put his bulk deal in that and make sure the price reflects it. But sometimes he may not want to that because his large deal will make a difference to the price. Second, as you know, international market is dominated by passive funds. So when passive funds come, by rule, they have to do it at the end of the day. And one big ticket comes and then distorts the whole price. So SEBI decided that let us align itself with the world practice. And the new system is nothing but, instead of 3:30, the cash trades close at 3:15 p.m. And then with that window, auction is held, where people quote for various numbers, and they arrive at an equilibrium price between 325 to 330. And so that equilibrium price then is the final price for the day for everybody. Now, while this system looks good on paper, there has been challenges there. First of all, the derivatives price is still at 3:40 p.m. So the difference between the cash price and the derivative price means arbitrages were stepping in. And it took a lot of time for traders in the Indian market to get used to this system. Second, for active fund managers, it represented a big challenge because now when they buy, their NAV is decided based on the closing price, but they have bought the stock during the day, but it will all be decided at the end of the day by this equilibrium price. So then they would find themselves at odds with the thing and their performance versus the benchmark would suffer. Whereas for passive fund managers, it has proved to be a boon, right? And we'll discuss that, I guess, in your next question, that it's actually a very good thing for the passive fund managers.
Okay, so how CAS help index funds and ETFs in reducing errors, which will eventually help investors also because they will get a better NAV for their index funds.
Absolutely. So the basic thing is that earlier, when an index fund got money, let's say I put in money into my index fund, and I have to choose the time at which to buy. And normally an index fund will try to match it at the closing price. But because the price gets distorted and he buys, and by the time he buys and the actual price decided in the older system, there would be a tracking error. And when people buy index funds, they want to buy the market. So when they find that end of the day, their returns are not matching with the market returns, because you go on any website, which tracks the markets, you'll say, okay, 6 month return of Nifty, so much. But my Nifty index fund is showing a very different return. So this was attributed to what is called tracking error. And this tracking error determines the performance of the fund manager. Higher the tracking error, the worse the fund manager has been in doing his task. So people were forced to look at various types of index funds, track their historic tracking error, and try to choose the best fund manager with the minimum tracking error. But now, with the one equilibrium price defined, all the index fund has to do is to come at the equilibrium price and offer its shares, so either buy or sell based on what the index happened. So the tracking error will be dramatically minimized. Hence, the difference between various fund managers will also come down sharply. Now you can just go and choose. So two benefits here. One, you don't have to waste too much time choosing an index fund manager. Second is that you can be confident that the market returns as disclosed in various websites and channels, right, would be what closer to the actual returns that you get. So it makes life for a passive fund much easier for the fund manager as well as for the investor.
And so index rebalancing trades will also be easier and more efficient after this closing auction session.
Undoubtedly. Undoubtedly, because when you have to rebalance, you're doing it at various times. So when, for example, I'll tell you this, when it happens when the index gets reset, when does the rebalance happen? Rebalance when the index constant get reset. So quarterly basis, the shares would change. So at that time, when they're wanting to change, they have to make, or let's say a stock moves out of Nifty 50, they have to sell all that stock that they hold in their fund, a 10,000 crore index fund, and given the weightage of, let's say, a Reliance stock, which is in double digits, HDFC, which is probably high single digits, in the index, and let's say there's a move. I'm not saying these are all very heavy weights, they won't move. It is the 45th to 50th stocks which are at risk of going out of the index, and the largest mid cap coming into the index. So when you make that move, the day the index rebalancing, only on that day you're allowed to make the change. Index fund cannot anticipate the change and say, oh, I know this is going to happen by the end of the quarter, I'll do it beforehand. No, he has to do it only on the quarter end. So that huge volume which comes in into the old system, the volume weighted average price, their sell order itself will come and affect the closing price. So that then various index funds are there and they have a half an hour window in which to go into it. Now that problem is taken care of because there's one equilibrium price which on that day of bulk movement also will be determined by an auction. So there is transparency and clarity and on index rebalancing days. And in fact, for foreign passive funds like those which are in the MSCI emerging market balance, right? The MSCI emerging market goes through this rebalance. We know now August 31st is going to be the next rebalancing. We already know which stocks are going to come in, which are going to go out. But all those trades can happen only on 31st August in the last a few minutes of trade. So this equilibrium price will make their job much easier and they don't need to time the market or game the market, and rebalancing becomes a much less of a headache and a sore point.
So my second last question, sir. Sir, but after the implementation of this new system, we have seen a lot of complaints by trader that in last few minutes, option price goes up by 400%, 800%. So do you think that this will settle eventually in coming days, or this will continue?
So I will say that it cannot completely settle, because what happens is, even in you have seen two orders passed by SEBI on manipulative practices. What were these? One was a bulk movement of a particular person. Second was an order cancellation. They just gamed it, the system. They just put in an order, and before the last 2 minutes, they canceled the order. But the price had gone into the system. So both these manipulations were caught by SEBI, and SEBI has instituted action. So these kind of people trying, he needs a lot of vigilance from SEBI to make sure these manipulative practices are minimized. So it will take a bit of time for SEBI to understand, because the human brain has limitless potential to find new ways to beat the laws. Right? We know that from the way income tax laws and the other laws are done, and people find loopholes. So human brain will always find it. So it will take some time for all kinds of manipulations to be identified and SEBI to bring it close. That's number one. Number two problem is that the fact of the matter is, for retail traders, it is very, very thick. They are the ones who are suffering a lot, because they are at the receiving end of this. They are not able to go and predict. And especially in futures and options, if you see anything which is, in the money, near out of the money, or what, during the last minute can suddenly come in the money, even if it is out of the money. So these kind of very close things, that they call it the decay, right? So there's a lot of things, and retail is suffering, is my feedback, and it will take some time for them. So retail trading, actually volumes may come down because they are a bit apprehensive. Then the issue for the active fund managers, there still remains an issue. I find that most active fund managers, mutual fund managers, are now trying to close off their actions by before 3:15 and not trade or do anything after that. Because they
Okay.
are also apprehensive in terms of the fact that there will be a discrepancy between the final price and their actions. So it will take time for the system to settle down.
It will take
But
some time for system
yes,
to settle
settle.
down, sir. Thank you so much,
Thank
sir,
you.
for joining us today and explaining this closing auction session so minutely in a simplest way to our viewers. Thank you so much.
Thank you.
So time for a short break now. After the break, we'll take your all queries, and your queries will be answered by Achin Goyal, CIO and Fund Manager at Bonanza Portfolio Limited. So we'll be right back after this short break. Welcome back after the break to answer your queries related to your portfolio, related to your mutual fund. I am joined by a very special guest today, Achin Goyal, CIO and Fund Manager at Bonanza Portfolio Limited. Thank you so much, Achin sir, for joining our show, The Money Show. Shall we start with our viewers' query?
Yes, Anurag. Thank you for having me. We can get to the queries.
Okay, so my first query I've received from the Narappa, age 45 year, investing for retirement, SIP of 60,000 per month, hold 6 mutual fund, investing from last 2-3 years, want to build a retirement corpus in 15 years. So, sir, investment SBI small cap, Axis mid cap, Mira Asset mid cap, SBI Focus, SBI Nifty Index, and Geo BlackRock Flexi Cap 10,000 rupees. So this portfolio of Narappa, sir, what would be your advice?
Yeah. So basically, as I reviewed the portfolio, he has a very high overlap between SBI Nifty and Geo BlackRock Flexi. Almost 50% overlap is there. At the same time, Geo Flexi Cap is not doing good. I mean, if we really look at the returns of Geo Flexi Cap versus other Flexi Cap funds, in almost I would say 1 year or 6 months, it has given roughly 0.5% compared to other funds which have given a return of almost 12%, right? So my only one piece of recommendation will be that he should exit Geo FlexiCap fund and try to get into Bank of India or 361 FlexiCap fund. Rest all funds are good, and with 60,000 rupees of SIP, he should be able to accumulate a retirement corpus of close to 4 crore plus.
Okay, so second question is from Dev, age 60 years, planning to invest 50 lakh rupees, need 20,000 monthly through SWP, 15 lakh for daughter's marriage, remaining corpus for long-term growth, emergency fund already parked separately in FD. Sir, Axis short-term fund 7.5 lakh rupees. Nippon India Conservative Fund 10 lakh rupees, ICICI Pru short term fund 7.5 lakh rupees, HDFC short term fund 10 lakh rupees, SWP portfolio of total 35 lakh, Aditya Birla liquid fund 7.5, Nippon India liquid fund 7.5, and daughter's marriage total 15 lakhs. So what would be your advice for Dev?
So thank you, but that was exactly my advice. So the this thing is, whatever the funds have been recommended or said by you are the good ones. I don't think there's any changes are required. As such, for 15 lakh rupees, they can be kept aside. Like you mentioned, for daughter's marriage, they can be into Aditya Birla liquid and Nippon India liquid, and rest can be into a combination of debt and conservative hybrid. That 35 lakh rupees can be invested there, and that will give a yield of almost 7.5%. So it's a very comfortable scenario for him at the age of 60.
I will share your response. I guess your frame is freezing. So, sir, can you hear us?
I can hear you. I can.
Okay. So next query is of Deepu. Deepu, age 32, NRI in Germany, focused on long-term wealth creation, investment horizon 20 plus year, 27 lakh parked in FD at 8% interest FD through SIP. Current SIP of 21,000 across 3 funds wants to gradually move FD money into mutual funds. So his investment SIPs is Parag Parikh Flexi Cap 3,500, Nippon India Small Cap 7,500, Motilal Oswal Mid Cap Fund 10,000 rupees. Sir, what would be your advice for Deepu?
For Deepu, I mean, there are two things. First is, should one shift directly 27 lakh rupees into equity? So my suggestion would be, go gradually. Initially start with 50% of it and move into conservative or aggressive hybrid funds. So I would suggest, Nippon India Conservative Hybrid Fund or, ICC Pro Aggressive Hybrid Fund. That is for the part which is currently into FDs, 27 lakh rupees. Now, coming to the SIP part, now you mentioned there are 3 SIPs. One is, Parag Parikh Flexi Cap Fund, Nippon India Small Cap, and Motilal Oswal Mid Cap. So, one of the fund, Motilal Oswal Mid Cap, is doing pretty good, but at the same time, there's a high concentration risk. So, I would suggest that the allocation in that can be reduced from 10,000 to 4,000. And 2 new funds I would suggest that can be added are Bank of India Small Cap Fund, Edelweiss Mid Cap Fund. Parag Parikh Flexi Cap Fund, I would suggest he should stop. The performance of the Parag Parikh has not been good. And also, given the current allocation, I feel there's a little lesser returns that we expect in the coming times, especially in the large cap side. So he can move into BOI 361 Flexi Cap Fund for that.
Okay, sir. So my last question, sir, because we are completely out of time. 1 more minute to go. So last query is of Murthy. Age 46, investing for retirement since 2019. Mutual fund portfolio of 1 crore. Monthly SIP of 2.2 lakh rupees. Nearly 80% exposure to mid cap and small cap. Hold multiple mid cap and small cap fund. And investment is portfolio review and SIP changes. Kotak mid cap 23 lakh rupees, Motilal Oswal mid cap 15 lakh, SBI small cap investment is there, Canara small cap, Bandhan small cap fund, Tata small cap, HDFC flexi cap, Parag Parikh conservative fund, Quant mid cap, and Motilal Oswal small cap. So, what will be your advice for Murthy?
So, first of all, I would like to appreciate him because he has so many funds, but the diversification is very less. I mean, the overlap is very less than 22% across all the schemes. At the same time, does it mean all the funds are good? I would suggest except 1 or 2 funds, rest all are good. One of the fund I would suggest that can be stopped is Quant Mid Cap. It's not doing that good. And he can add exposure against that into Motilal Small Cap Fund. Another fund I would suggest him to reduce exposure is Kotak Mid Cap. It's a very high concentration right now. Amongst once you are 23% is into Kotak Mid Cap. So that can be diversified into Edelweiss Mid Cap. So apart from that, overall the portfolio is pretty good. And given the SIPs, I don't have SIP data per se, but overall with 2.2 lakh rupees of SIP, in which fund he is doing, I don't have, but these are the recommendations from my end.
Okay, sir. Thank you so much, sir. We wanted to take more queries, but we are completely out of time. Thank you so much for your responses for our viewers and sharing your insight to make their investment strategy better. Thank you so much. So that's a wrap on this edition of the Money Show. But stay tuned to ET Now for more news and updates on the other side. Thank you so much.